Welcome back, everybody, to We Are TPM with myself, Kyle Teixeira. Sitting across from me again is John Teixeira.
Yo.
And this week we got Trever Kerr with Gateway Mortgage with us to talk about should you consider an A.R.M, aka an adjustable rate mortgage.
I love it. Welcome, Trever Kerr. Thanks for joining us.
I appreciate you guys having me today.
So I'm remembering, Kyle, back in the day, okay, before I started actually selling and doing what I'm doing now.
Your day, right?
My day. Back in my day. You were wee little, probably on my knees somewhere. And adjustable rate mortgages got really popular because we were kind of in the stage that we just came out of the market where prices were being inflated, they were going crazy. Affordability was getting out of hand, right? And so adjustable rate mortgages became very normal, especially during the refi boom, as people were refinancing and pulling money out of their house. And we weren't doing that as much here in Texas because we have some laws protecting us from it. But across the country in general, that's what was happening, Trever. I think a lot of this going on even before you got in the business, right?
Oh, yeah.
And so it's great for me that now we're sitting here today having this topic. You and I were talking. We were having dinner the other night, and you and I were talking about the where we were going with the market and what the smart play was for buyers. So talk a little bit about that. Why don't you start with just telling us what's the difference technically between an adjustable rate mortgage and what people are used to with a fixed rate mortgage?
Definitely. And just kind of touch base on that A.R.M and stuff. I've been doing this for 20 years now, and really and truly, A.R.Ms weren't real popular at that point in time, but it is a product right now that I am recommending for a lot of my clients for a couple different reasons. But just kind of break down what an A.R.M is. It's still a 30-year amortized loan on an A.R.M. Okay, there's several different types of A.R.M products: 3-year A.R.Ms, 5-year A.R.Ms, 7-year A.R.Ms, so on and so forth. But basically, one of the products that we're doing a lot with right now for clients is it's called a 5/6 A.R.M. Okay. And what that means is it's a 30-year, loan, but for the first 5 years of this loan, it is fixed at a much lower interest rate than what a standard 30-year fixed is going for right now. At that point in time, so you are 100% protected for 5 years, knowing my rate's not going to change. Okay. At that 5-year mark, that 5/6, and what that 6 means is it adjusts every 6 months after that 5-year mark. Okay. And what happens at that point in time, they have max caps and adjustments based on these, and each one of them is a little bit different. But today we're talking about that 5/6 A.R.M. So after 6 months, okay, it can adjust 1 percentage point per year. Okay. So if that first adjustment's 1%, it can go from, say, right now, interest rates on that 5-year A.R.M is right at 5.75%. So it could go to 6.75 within that first year of that adjustment. Okay. The beauty of it, and the reason why I'm recommending that for a lot of clients right now, is every expert and professional, there's no guarantees on it, but everyone is on the same consensus that interest rates are going to come back down here in another year or two. Okay. So even if you are financing on a 30-year fixed rate or a 5-year A.R.M or a 7-year A.R.M or something like that, most likely you're going to be refinancing in the next couple of years. So why not take advantage of the much lower interest rate on that A.R.M product than that 30-year fix in the short term?
So you're essentially taking a lower rate now and planning to, within the next 5 years, refinance that into a fixed rate when we get back to, or I say when we get lower interest rates.
When we get lower interest rates, exactly.
So I got 2 questions that came up. So one is, what does it look like so you said that it's a lower interest rate. So explain to us, Trever, what the difference is. What does it look like if I decide I want to do a 30-year fixed, right? What is my interest rate going to be compared to what it's going to be with this 5/1 A.R.M or 5/6 A.R.M?
Obviously, it's going to depend on credit scores and stuff, but if you're looking at doing a 30-year fixed rate mortgage on a conventional loan right now, you're looking at over 7% interest rates right now. Okay.
Wow.
So the 5-year ARM.
Is that with the recent move that just happened?
That's with the recent adjustment last week.
Okay.
In interest rates.
It's about triple what it was a year ago today, right?
It is almost triple, but yes, we've seen a huge increase, which of course changes affordability on homes.
Mm-hmm. Yep.
And so when you're looking at, if you have a customer that's been shopping around in this crazy market for the last year, and all of a sudden they were looking at a $400,000 home, a year ago when interest rates were 3-something%, okay, and now interest rates are 7%. Well, guess what? That 400,000 qualification now all of a sudden just turned into about 250, for a person. So we're using this program a couple different ways. For one, everyone likes to save money, and if you're going to be refinancing anyway in the next 2, 3, 4, or 5 years, you might as well take advantage of that huge difference in monthly payments.
That's a huge difference.
Yeah.
It's a huge difference.
It's a big difference.
So in my eyes, I love that product for people. It's not for everyone. I've talked with customers. They just have, the negative thoughts that a lot of people have on ARMs.
It has a very negative connotation, isn't it?
The great thing about that product too, that rate doesn't just only adjust up. It adjusts down too. Yeah. So whenever we get to that 5-year mark, if for some reason you didn't refinance at that point in time, but now interest rates are at 4-something%, guess what? That rate's coming down. It's not going.
Is there a limit on how far it'll go down?
There's a 2% cap of what it can go down to. So if you're at 5.75 and the rates get all the way back down there, you're looking at 3.75, over the course of 2 years.
And the thing about that is that's a market-driven thing. That not only is it market-driven, but you can I almost said open up your newspaper. It's 2022, isn't it? You can go on your phone and you can look and see, because that's based on the LIBOR, right?
It is.
So you can look at the LIBOR rate and find out what that is on a daily basis, and as it's moving every single day, right? You can see what that is for yourself. So when you sign your loan documents, you know that this loan is going to be X amount of percentage plus or minus, right? The current LIBOR. Isn't it usually like 2% plus LIBOR or something like that? So if you know that the LIBOR is, at, 3.785 today, and your interest rate's about to move, you're coming up on that date, it's about to move, then you know in advance it's going to be at 5.785, right? Yeah. Am I right about that?
That's correct.
One question that comes to mind, I guess investor-based questions be, can you buy points on an ARM?
You can. Okay. You can buy points on an ARM and stuff, have a lower rate and stuff on an ARM just like you can on a 30-year fixed. Again, my recommendation right now is I don't like seeing customers buy a lot of points right now.
Because you're planning to refinance.
Because you're planning on refinancing anyway. Mm-hmm. So
it's like throwing money away.
Yeah.
Yeah.
Probably significantly before, we never know what's going to happen, but I'd say before 5 years.
Oh, yeah.
This cycle's got to go the other way.
It is. I'm kind of looking at the 2-year mark right now. Is when you're going to see a big refinance boom of everyone that is purchased here in the last 6 months is most likely going to be refinancing.
Trevor, we didn't talk about this, but what are the technical, I guess, what are the market-driven things that are going to cause that to happen? I know you're watching this and you're looking at it on a regular basis.
Well, right now, of course, the Fed is kind of, for so long, the Fed artificially kept the rates down lower than they should have been at one point in time, but now they've switched directions and are actually going the opposite way to try to, stave off and fight inflation,
our economy.
Slowing down our economy. So they can only do that to a certain extent. I think they're at about the max before they shut our economy down.
I think they've indicated that this is last rate. Most likely will be the last one.
So at that point in time, as soon as we, stave off inflation a little bit more and stuff, rates are going to settle back down. Of course, all the experts and stuff say too, come election time and stuff, rates are going to come back down a little bit and, change in
well, that turnaround helps because they price that in. The market at least prices that in advance. I mean, they've already priced in the next hike in November. So if it doesn't hikes.
That's correct.
We'll be going down. So it's optimistic.
Yeah. And I mean, at that point in time, it's not when they come back down. I don't think we're going to see levels in the 2s and 3s ever again. So I don't want people thinking of, okay, I'm going to do this ARM and here in a couple of years, they're going to get back to 2, high 2s, low 3%. I don't think that we're heading back to that direction, but I do think rates will come back down in the high 4s, low 5s.
Yeah, I remember when I bought my first one in 2017, I think I got a 4.5, and that was amazing at the time. Yep. So, the 2.5s that people are shooting for again that's
just not realistic.
Took historic events to make that happen. So, the other question I have is a lot of people who have gotten a lot of equity in the last 2 years and maybe refinanced at the front of this whole refinance boom, they're looking at their equity trying to cash it out. So can you do cash out refis on ARMs?
You can do cash out refis and stuff on there. At that point in time, depending on what equity position you're at and what current rates you are, I probably wouldn't be looking at doing a cash out refinance and turning that 3% that you have or something into a high 5% on an ARM. My recommendation on that, if someone is looking at doing that, is actually keeping your current loan in place and looking to get a home equity line of credit, that's at a higher rate, but at least you're not turning your entire mortgage into that higher rate.
Yeah, you got a smaller piece of what you're cashing out at a higher rate. So
that's correct.
Percentages like smaller amounts, right? At least when we're paying interest.
Yeah, exactly.
So Trevor, talk a little bit, since we're really investor focused on this particular podcast. We try to, teaching people how to build wealth. And while that starts with your own home, right? So that's also important. Talk to the investors out there that are buying homes for, they're putting 20-25% down. Are they using this? Are they doing this as well?
Yes. Every one of my investors that have been buying recently is doing this as an ARM. Okay. Because they're really in tune what's going on in the market. Most investors are and stuff. And they totally agree that yes, 2, 3, 4 years down the road, we're going to be refinancing anyway. And some investors, have different, logic and plays on it that they might be, selling their home.
They might be short-term.
Yeah, short-term stuff.
Holds, yeah.
And so then 100% it makes sense for them. But even the other ones, when you start talking about, the difference of a point and a half difference in rates, I mean, depending obviously on the loan amount that you're looking at, you're talking $300-$400 difference a month cash flow, looking at that instead of a 30-year fixed rate. So the investors that are buying right now are almost 100% of them are doing this ARM.
So can I take us a little bit sideways off topic, Kyle? You mind?
Why not?
We got Trevor here. We got Trevor here in the studio, and
this
Kyle
could be scary.
It could be scary. No, it'll be fine. Kyle, and this might play right into what we're talking about. So Kyle and I talk a lot about the Burr method. Mm-hmm. Are you familiar with the Burr method? Burr.
Wouldn't say we talk a lot about it, but it's a method. Yeah,
we do. Well, no, we bring it up a lot. We've talked about it. We've done an entire podcast on it, and we bring it up a lot. And so those people that are thinking about doing that, buy, rehab, rent, and refinance and repeat, right? Mm-hmm. That part that you play in that refinance part. Talk a little bit about how that works compared to you would normally do it, because I know there's some timeline limitations, and then
there is,
and then go ahead and circle back into how you might use an ARM to do that.
So, as John was talking about, buying and rehabbing and then come back in there, at that point in time, obviously that plays into how much that house is worth at that point in time. So a lot of these people that are buying and rehabbing stuff, they might have bought this home at $200,000, initially and stuck, $50,000 into rehabbing it. Mm-hmm. at that point in time, that house now might be worth $350,000, $400,000, so on and so forth. So
that's the idea.
That's the idea of it. At that point in time, they can recoup their investment by taking cash out up to, maximum 75% is what they'll lend you on investment property.
75% of the new
appraised value after 1 year, of you purchasing that property.
There you go.
So what a lot of investors do.
So we've got to wait the whole year before we do that.
Got to wait a year,
okay,
before we can go off the new appraised value and stuff. But a lot of investors do that method and stuff because now all of a sudden, not only are they recouping their down payment that they did, they're recouping the money that they invested to rehab that home, and depending on exactly, how much, they might even be getting enough money to have the down payment for their next home. Mm-hmm. So when you start figuring all of that out at that point in time, yes, there's a time requirement that we got to wait, but an investor that is doing that can literally almost have all their cash back plus their down payment for their next one to move on and do it again.
And that's the goal of a good investment deal with rental property, right? Is you come out at the end with all your money back, and now you got a property that's cash flowing.
Yep. Love it.
And an asset.
What about Trever, in that scenario, what about the investor that has taken out a high interest private loan or hard money loan, and they don't want to wait that entire year?
If they don't want to wait that entire year, that at that point in time, we can't get them any cash back, on it. But they can take that high interest private money loan. They can come back and do a refinance with us a month later, a week later, or whatever.
So if I don't want the money that I put out to rehab, if I don't need that back, and I just want to refinance my $200,000 loan in the example you used, I can refinance that with you.
You can refinance that right away.
And of course, it'll add to your costs in the end, but then at the end of that year, still, they could do a cash out, right?
That's correct.
They could refinance it again for a cash out while paying a lot of double fees, I should say. But they could.
You're gonna have closing fees, twice if you went that direction.
Cheaper probably than the interest-only hard money loan. But.
So to circle this back to our topic at hand, we can use adjustable rate mortgages to accomplish this in both those scenarios?
Most definitely.
It's kind of our topic at A.R.M, right? No.
That was a stretch at a pun. I'm not sure if it worked or not.
Tried to give a dad joke to my dad.
I really appreciate the effort there, Kyle. I'm just not sure it worked. But
I'll leave that to you then. No, it's okay. So I throw
do these
you
things?
off.
Well, okay. So you want to pun this thing? So tell us, Trever, are these things going to cost us an arm and a leg?
It's not going to cost you an arm and a leg. It's just going to cost you an arm.
Just an arm.
Just an arm.
Yeah.
But no, in all seriousness, what's the differences between I'm going to get a standard conventional fixed rate loan? Is there anything else that we need to know about or any other difference?
No, you're going to have the standard closing costs on an ARM that you're going to have on a 30-year loan. Obviously, like we talked about, you can purchase the ARM rate and that index. And what's kind of going on in this market right now as these banks are looking at it and stuff, and why pricing is changed considerably as well, is the banks and Fannie Mae and Freddie Mac and stuff, they all know that these mortgages that are being produced right now are about 95% likely to be refinanced here shortly. Mm-hmm. Okay. So the yield spread that they're paying and stuff they're making, there is none out there because they know this is going to be a very short-term loan right now at this point in time. So what's going on in this market right now, there's a lot of different rates and programs that you cannot even get what they call as par pricing. Okay. It's going to cost you money to get a loan right now to basically paying points on a mortgage, most likely. So
because they want their money up front because they know they're not going to get it over time.
No, they're not going to get it over time because it's going to be refinanced in a year or two, 3 years. And that's a bank that's purchasing that and stuff and servicing that. There's just no money to be made in a year or two, on there. So they're not, most of the time, rates are costing people money right now.
And that's what the Fed wants. That's what the rate hikes are for, is to make money more expensive, right?
Yep.
So sounds like they're achieving that.
They definitely have.
So, and that's how we know it'll, at least to some degree, go the other way to balance out the market like anything else that's cyclical like that.
So, Trevor, you are, just to kind of reiterate, you are recommending to all of your clients, 100% of your clients, this is what you should be doing right now.
Well, I say 100%. This is only a conventional loan product. Okay, you can't do this on government loan products. So obviously, someone looking to do a VA loan, FHA loan, loan down payment, it's just not even an option for them. But anyone that fits that criteria that can do a conventional loan, most definitely you're pushing them in that direction. I'm just educating them the difference between them, letting them make the decision. But after kind of explaining it and showing what the market trends are and what it's going to be, and the advantages of, hey, monthly payments $400 cheaper a month, you start adding that up over whatever you want to do, 2 years, 3 years, 4 years, 5 years, that's a huge savings.
Yeah, love it.
That is a huge savings. I mean, if you're looking at refinancing in 2 years, then you're calculating that into how much more you're spending by keeping the conventional loan. So,
most definitely.
I guess my only other question is, what is I know the market we're currently in, where there's not many yields on, the 30-year fix, but is that generally the difference in rate for an ARM? Is it like you're about 2 points right now?
It's right now that ARM rate is averaging about 1.5 points cheaper. Than what a 30-year fixed would be. Again, the yield and stuff on there is there's not any yield for the banks and stuff anymore. Okay. They're borrowing the money a lot more, it's a lot more expensive from them. Okay. Obviously no one's lending money and losing to do it.
Yeah.
So at that point in time, they're not getting any yield premium and stuff by selling these loans because of the fact that they know it's going to be refinanced in a very short period of time.
Yeah.
So, the difference in ARM rates and 30-year, fixed rates used to only be a difference of about 0.5 percentage point. Okay. Right now with where it is, it's about 1.5. So it's a huge deal.
And there's probably some psychology that people probably won't think about it for 5 years if they're comfortable with this rate. And then they'll make their money, at least some.
With my clients and stuff, I do a yearly review on it and stuff. So, yes, if rates at that point in time, if my client is very, skeptical about what's going to go on, as soon as rates, drop back down to at least what their ARM rate is, I'm going to have that conversation with them and say, okay, here we have a chance to now lock that 30-year rate in at what your ARM rate was at, and kind of look at what the trends projected to be for the next, 6 months, next year or something, and see if it makes sense for them at that point in time. But that is the idea. If you're going to You're most definitely going to be refinancing here in a short period of time, whether it be 1 year, 2 years, 3 years, 4 years down the road. So at that point in time, why not take advantage of the lower rate when you're going to refinance? It's going to cost you the same to refinance an ARM as it is a 30-year fixed rate. So let's reap the benefits of that $300, $400, $500 cheaper monthly payment for that first year, 2, 3, 4, before you do that refinance.
And I guess for all those reasons and the high rates reasons, you wouldn't be suggesting 15-year loans to people right now.
No, the 15, even though the 15-year rate is lower than the 30-year and stuff, at that point in time, we get back to home affordability, doing that 15-year rate,
You're gonna be it affects affordability a lot faster.
It is, because even that 15-year rate right now is a little over 6%.
Well, and to your point, why even do that if you know you're going to be in a position to refinance within the next 5 years? So, if you want to pay something down faster, you can just as easily pay more toward your principal
every single month.
That's month correct. Instead of doing that. and then you're in a better position when you refinance and you're not paying as much interest and all that good stuff. So
wasn't suggesting that. Just playing devil's advocate
it was
a little bit.
It was a good question because we've done 15 years on a few things. So,
all right,
Trevor, thanks for that, man. It was a great perspective. We hadn't even talked about ARMs here, and it's just we're probably at the beginning of this new wave of ARM loans. You're not really hearing anybody advertising it on the radio. I mean, nobody's really talking about it. The conversation you and I had over dinner is really the first conversation I've had about adjustable rate mortgages in a really long time.
Well, there's subtle things too. Like when I log into my bank's website now, it's got the credit card rates and mortgage rates. Well, now it shows the 30-year fixed and the ARM instead of the 30-year fixed and the 15-year fixed like it used to show. So they're already subtly swapping that in because they don't want to be suggesting 15-year fixed or showing the rate for it. So.
There you go.
Well, we appreciate you coming in with us, Trevor, and talking about ARMs. Maybe we'll talk about legs soon.
There you go.
But if people want to talk more about them, how do they get a hold of you?
They can give me a call anytime at 972-822-7408 or send me an email at Trever, TREVER.KERR at gatewayloan.com.
If you're anywhere in DFW and you need loans, Trevor's the guy to call.
Anywhere
He's the
in
only
Texas,
guy to call.
Anywhere in Texas. You know what, Trevor, thanks for doing this, man. Trevor has been our preferred lender and an extremely good friend of ours for 15 years now, something like that. We've been working together.
Yeah, 15, 16.
I trust him with all of my clients and my kids and everybody else. So I appreciate you very much, Trevor.
Appreciate you guys having me.
For sure. And if you want to get a hold of us or talk to us before you talk to Trevor, or we'll push you to Trevor, or whatever you want, give us a call, 817-818-9039. Shoot us an email at showmethemoney@wearetpm.com. Thanks for tuning in.
We out.